Hey everybody, this is Elaine Rasmussen. We are celebrating 1 year of the Do Different Better show. I could not have done it without you. Thank you so much. Today we're going to be playing some of our favorite moments from past episodes. So enjoy and can't wait to see you in next year. If you are out here activating how to build wealth and deliver value to your clients, then this episode is for you. In last week's episode, we talked about understanding 4 key financial documents for your business, whether you're an inspiring investor, an entrepreneur, or just really curious about the company you work for so that you know when it's a good time to ask for that raise or that transfer. That episode helped you decode the numbers and learn what they mean and how to use them to your advantage. But today we're going to be talking about consultants and something that people are struggling with, particularly women and people of color, and that is pricing your worth. So once again, you've got to be really aware about this if you're really trying to build a financial wealth building strategy for yourself and your family. So understanding if you're a solopreneur, what that's going to look like, this is a show for you. I'm going to be talking about pricing and how to set your prices, and what you can do if you're really struggling with all of that of pricing your worth. We're going to be getting into why the rates are important and how it's more than just a number, and how to shift your mindset and how to build confidence to claim what you deserve. My main focus is going to be on service-based businesses. I'll tackle product-based businesses in a future episode. So how did I get here today? I was on a call literally yesterday with a network of solopreneur consultants who are my fellow alums from the Just Economy Institute. And one of my colleagues was going to be going to a client meeting later that day and wanted some help on how she should approach her pricing, since this was going to be a 300 personal professional development facilitation for a major university where she lives. It was such a great, vibrant conversation. I thought, these folks can't be the only ones struggling with this topic. And that's when I knew I had to share what came up with all of you. So here's a not so fun fact. Did you know that according to the study of Freelancers Union, they found that women freelancers often charge less and significantly less than men do for the same services? But let me tell you something, knowing your worth and pricing accordingly isn't just about being empowered. It's really essential to running a sustainable business. By the time you're done with this episode, you're going to have some tools that you can confidently say, here's my rate, without flinching and with a smile that says, yes, I'm worth it. So let's get into it. First, let's talk about pricing. Pricing is a crucial aspect of any business. It directly affects your bottom line and profitability, especially as a solopreneur, since this might be your main source or only source of income. But before we dive into the specifics, let's first discuss why pricing is important. Pricing determines the value placed on your product or service and ultimately impacts consumer behavior or how your customer behaves towards you. If your prices are too high, customers may look elsewhere for more affordable options. On the other hand, if your prices are too low, you may not be making enough profit to sustain or grow your business. As a retired communications professional, I can't tell you how much psychology and some guesswork go into figuring out your pricing, even for some of the big guys. Finding the right balance in pricing requires really understanding both internal factors of your business, such as the need for additional support, travel, production or administrative costs, external factors such as market demand and competition. It's also important to consider the perceived value of your services in relationship to your competitors and the general marketplace. But why is pricing more than just numbers? It is a mindset. It is about boundaries, and it is about recognizing your value. So let me tell you a quick story. Years ago, I met a brilliant consultant named Jamila. She was running herself ragged, charging low rates, and accepting every single client that came her way. One day, she realized she was really barely breaking even. Why? Because she wasn't factoring in her expertise or the time she spent prepping outside of client meetings.
Jamila recalculated her rates to reflect the real value of her work, and within a year, she doubled her income. The kicker, her clients respected her more because she respected herself. So here's a quick exercise. I want you to write down 3 things that makes your service unique. Think about your lived experience, your professional expertise, and your ability to connect with your clients, or at least their problem, or you have a creative solution that you're providing that's not in the marketplace. These are all value adds, and they should be reflected in your pricing. Now let's talk about the hidden costs of consulting. It's not just your time. It's the software, it's your health insurance, it's even your mental energy that it takes to deliver your best work. I know for me, when I do a facilitation with a group, it doesn't matter what size of the group, but I need an extra day or 2 off after I do a facilitation because it takes so much out of me. But don't worry, we're going to dive into packaging your services a little bit later in the show and how do you calculate and factor in some of that downtime into your pricing. But first, next up, I really want to talk about shifting your mindset. Pricing your services is not just about your time. It's about the years of experience, the tools that you've developed, the unique perspective that you're bringing to the table. But understand you are in the business of selling your time, which is not infinite. You can't go out and make more time. So you have to be mindful of its precious value, not just to you, but to your clients, right? Now let's talk about what might be getting in the way. One of the biggest barriers to confident pricing is fear. Fear of losing clients, fear of being told no, fear of not being worth the rate you're asking for. Let me squash that fear with some truth. The right clients will value your work and pay your rate. The wrong ones, well, they're not your clients. I want you to adopt this mantra for me. My rate is my rate. My rates are not up for negotiation. My expertise is valuable. My time is priceless. Okay? So once again, my rate is my rate. My rates are not up for negotiation. My expertise is valuable. And my time is priceless. Write this on a Post-it, stick it on your laptop, put it on your mirror, say it to yourself as you're getting ready, you're fixing your hair, you're putting on your makeup. Remind yourself of this every time you have a discovery call or a scope of work call. Maybe you say it to yourself before you get on the call. But I'd make it a regular practice so you can start building a different relationship with your pricing. So, if this is so important, I can't tell you how often I find that so many people are undervaluing their rates. They're not charging. And, I want to give you a few practical tips that you can think about adopting, right? So the first practical tip is practice saying your rates out loud. Maybe while you're in the car driving to a client, maybe on your way to driving to your co-working space, maybe on your way to driving to the grocery store. But stand in front of the mirror or look yourself in the eye in the rearview mirror and say, my rate is $250 an hour, or whatever your rate is. Repeat it often and frequently until it starts to feel natural. And depending on your rate's going to be obviously based on what's your level of expertise. Are you new to the market? Do you have less expertise or less experience than maybe somebody else? Also, what is the traditional rate for the field that you're in? The group that I was talking to yesterday, many of them work in the philanthropic sector. So a typical rate with somebody of 10 years experience or more is about $200 to $300, right? If you're new, let's say you maybe have 3 years experience, maybe you're going to start off at like $75 to $100 an hour. And as you build up more expertise and you build up more network and you build up more value add to what you have to bring, you start to increase your rate, right? Number 2, anchor your rate with confidence. When pitching or submitting a proposal, start with the value that you're providing. So here's an example. For this project, which includes strategy sessions, a custom roadmap, and my follow-up, my rate is $10,000 for this project, right? So you're establishing what you're going to be bringing to the table. So when you name the price, it's going to be less of a shock. It might still be a shock, but once again, then you have an evaluation to make of whether or not this is the right customer, right? And I'm going to talk about where you might want to deal with, choose that customer for some other value add for yourself. But for right now, anchor your rate with confidence. So once again, I want you to talk about what is the value you're going to bring, what are the deliverables you're going to bring to the client, and then establish, say, what your rate is going to be, whatever that number is, and don't back down from that number. Another thing that you can do is really start to think about what is the base of what baseline can you take, right? But the other thing that I also offer to people whenever I'm speaking on a panel, I get often asked to speak about establishing rates or talking to consultants. But the other thing that I tell, especially women, is raise your rate. And I would encourage you to raise your rate every year, especially if you are uncomfortable or very fearful about what your rate is. I really want you to just raise your rate. The first time, my first couple of years in business, I just had on January 1st, I raised my rate by a minimum of 10% every year. That's just what I did. What that did was created some objectivity around raising my rate. It took a lot of the fear away because I'm just saying, this is what I'm going to do. And what I would do is a couple of months before the end of the year, I would send a message to all my clients, letting them know that in the next year, my rate would be going up by X amount of dollars or X amount of dollars per hour, or that there was just, if I did a lot of project work, I would just say the rate is going up by 10%, by a percentage point. But once again, if you're too afraid or you don't know how to do that math to calculate what your rate increase is going to be, start with something objective and simple and say, hey, I'm going to raise my rate every year for 10%, by 10% for the next 3 years. Now it's just set in stone. It's not something you have to think about. It's something that's on autopilot. But I think in doing that a couple of years in a row, you're going to start to understand the marketplace of what's people's reaction to your rate, but you're also building in the cost of everything goes up every year. And now you're factoring in cost of living increases. You're factoring in the rate of inflation, right? Just like everybody else is doing. I'm sure you get the emails from your subscription providers. Netflix is famous for this, about letting people know that they're increasing their rate. If Netflix is not concerned about raising their rates and letting you know that they're raising your rates, neither should you, okay? So I really want you to start building this relationship with thinking about your value and the price that you're going to set. Because once again, this is going to allow you to be able to practice some of the other investing tactics that we've talked about in other episodes, whether it's saving for retirement, saving for a big vacation, saving for buying a house, saving for your children that you might be expecting. But if you're a solopreneur, this is even more important because this may be your single source and only source of income, right? So I really want you to get a better relationship and wrap your head around some of these things. So think about some corporate consultants like McKinsey. McKinsey is one of the largest. I think there's others like Deloitte. They charge astronomical fees, and they are very unapologetic about those fees. Why? Because they believe their services bring value. You don't have to be McKinsey to have the same level of confidence. Your work matters. It is valuable and important, and it deserves proper compensation, right? Especially for you to get to the goals that you're looking to attain. For those of you who want to dive deeper into building more of your confidence, I encourage you to check out You're Worth It by Amanda Steinberg or Build From Now by Damon Brown. Those are a couple of really good books that I have not personally read them, but I've heard that they're really great for tackling these issues. But once again, I love my philosophy is the fake it till you make it. Even if you don't believe that your rate is worth $200 an hour, try it on for size. Go in your next client meeting with that rate and see what happens. You never know. They just might not blink at it. If they do, you can always negotiate down. But I really want you to get into this practice of really starting to just experiment with thinking about raising the value or at reassessing the value that you bring to the table for the work that you're providing for your potential clients. So here's your homework for today. I want you to review your rates. If you've got multiple rates for different kinds of clients or different kinds of work, Review them. Do they reflect your expertise, your expenses, and the value that you bring to the table? If not, it's time to make an adjustment. I was talking to one founder and she said she hasn't raised her rates in 5 years. Everything has gone up in 5 years. Everything. The price of eggs have gone up in 5 years. If the price of eggs have gone up, you probably need to raise your rates as well, okay? Don't be shy. Reach out to me on social media and tell me what your new rate is. I want to be able to celebrate with you. So we're wrapping up this segment. You've been listening to Do Different Better. I'm your host, Elaine Rasmussen. Next up, we're going to be diving into crafting a pricing strategy that works for you. We'll talk about packages, sliding scales, and when and how to offer discounts. Don't go anywhere, my brilliant biz bosses. We're just getting started. See you back after the break.
You're listening to the special one-year anniversary episode of the Do Different Better show. Stay tuned, as up next we'll play back more of our favorite clips. And continuing our celebration of the one-year anniversary of the Do Different Better show, we'll now play back another one of our favorite clips.
Welcome back, my eco-conscious money movers. In this segment, we are doing a deep dive into how you can actually find and evaluate social responsible investments. So first, let's start with ESG ratings. So remember, these are the scores that the companies are given based on their performance in environmental, social, and governance criteria. But here's the question. What are ESG ratings and how can you use them to make smarter investment decisions? ESG ratings are essentially a report card for companies telling you how well they're doing in terms of their sustainability, their ethics, and their governance. These ratings are determined by agencies like MSCI or Morgan Stanley Capital International. That's one organization. Sustainalytics and Bloomberg. Those aren't the only ones, but those are some of the big ones. They evaluate companies based on a ton of data, including their carbon footprint, labor practices, board diversity, and how transparent they are about these business operations. What's great is that you can easily find their scores online. A simple search for ESG rating in the company and the company name will usually lead you to their rating on platforms like Bloomberg or Yahoo Finance. The challenge with this is that these ratings you'll see mostly associated with larger companies. Smaller companies, particularly local, even multi-million-dollar companies, may not be rated on these platforms. Even some of the publicly traded companies may not be rated on these platforms. So you just want to know, like, it's not going to be a winner-take-all situation where you'll be able to go in and find any company that you might want to invest in, particularly smaller companies. But there are ways to know that a potential investment is ESG or values aligned. There are things that are called benefit corporations. These are actual tax entity structures. So it's still like a regular corporation. However, it's they're what's called a benefit corporation, and that is a filing that they do, an entity structure that they file for. Benefit corporation status is not available in every state. An example of a benefit corporation is Ben & Jerry's. They're located in Vermont, but a benefit corporation basically means that we are here for some sort of benefit. I think you're going to catch a little glimpse of Skittles in the background here. He wanted to make an appearance in the show. Another one is certified B Corps. Certified B Corps go through a rigorous process that is done by an organization called B Lab, and they issue what's called B Lab certification. My company, Social Impact Now, is a B Lab certified company, and it is not easy. You have to demonstrate through not only an evaluation process, but a due diligence process that demonstrates that, yes, what you've mentioned in your assessment is true and that you are following certain criteria that indicates that you are focused on one or more parts of ESG or social responsibility. But that's really important that I want you to know is that these monikers give you clues that a company has some sort of ESG or values-based or social responsibility lens in how the company is managed and what it values, and that's important to them. Another organization is what we call SASB, or the Sustainable Accounting Standards Board, SASB. We call it SASB for short. It is an independent nonprofit whose mission is to develop and disseminate sustainability accounting standards that help public corporations disclose material and decision useful information to specifically investors. Another organization who I love, I've worked with them in the past, they're amazing, and that is As You Sow. As You Sow is a corporate accountability nonprofit, kind of like a watchdog organization. They publish reports on good and bad players, benchmarks, and are very active in what's called shareholder advocacy. Shareholder advocacy is the act of leveraging your position as a stockholder through your voting or driving conversation towards ESG aligned business practices like diversity on the board, setting corporate responsibility metrics, investing or divesting practices. If you want to know more about that, I have a workshop coming up that takes a really deep dive into this topic. You can DM me on IG or LinkedIn to get an invitation. But here's a fun fact. ESG ratings aren't always clear-cut. Take Tesla, for example. Tesla gets high marks for its environmental impact because of its focus on electric vehicles. But it's also lower marked in governance because of the board structure and other issues, particularly with the CEO, Elon Musk. So don't just focus on the score when you're looking at in making an investment in a company. Dig in a little deeper into the specific categories to see where the company excels and where it falls short. And then you can make an assessment on where does that lie for you? Once again, if you've defined your values, it'll be a lot easier to say, okay, this is the pluses of the organization. This is the minuses of the organization. Here's where my values are. And triangulating across this, this is or isn't a good investment for me. So thinking about all of this will help you understand and strike a balance that can have you make more informed investment choices, right? Okay. Now that you know how to read ESG ratings, let's talk about building a climate conscious portfolio. This is where you take ESG ratings and actually put them to work in an investment strategy. So, what kinds of companies should you be looking at if you want your portfolio to be more environmentally and socially responsible? Number one, having a sector focus. Start by focusing on industries that are actively improving or actively working to improve sustainability. Look at sectors like clean energy, sustainable agriculture, water management, waste reduction. These industries are the key players in the fight against climate change, and they offer strong long-term growth and potential. 2, green bonds. If you want a more secure fixed income investment, consider green bonds. These are bonds that are issued by companies or governments to fund projects that have a positive environmental impact, like renewable energy plants, wind turbines, upgrading water infrastructure, like we're seeing in some cities. They offer a way to support green initiatives while earning steady interest on your investment. Number 3, exchange traded funds. I did a whole show on what exchange traded funds are, but they're also called ETFs. If you're just starting out and don't want to spend too much time picking individual companies and you don't have time to do a lot of research, consider ESG focused ETFs. These funds bundle together a bunch of companies that meet certain ESG criteria. So you get instant diversification and exposure to socially responsible investments. Some popular ESG ETFs include iShares Sustainable MSCI Global Impact ETF. I know that's a mouthful. And Vanguard's ESG US Stock ETF. These are not sponsored. So once again, I don't know what's all in these portfolios. So definitely
you should take a look at this, right? Go look in for yourself, do your own due diligence. So here's an action step for you. Take a look at your current portfolio. Are you already invested in companies that align with your values? If not, research ESG focused funds or ETFs that you can add or you can swap in. Start with something simple. Find one fund that matches your values and consider making the switch. Okay. Whew, that was a lot. Now, I know some of you may be wondering, is sustainable investing really profitable? And that is a big conversation that is happening across ESG. I remember when I got into this back in 2012, that the conversation was there was no way to do that. And I'm pleased to say, one, not only is there a way to do that, there are market rate return ESG focused investments that are great. But there's also, if you don't need to necessarily make market rate returns, or you're willing to make concessionary market rate returns, there is a correlation in my estimation between the impact that you want to make and the type of returns that you want to make. That is not to say you can't have impact and returns at the same time. I'm not saying that. But in my estimation, and according to my research, your impact is directly and inversely correlated to the returns you need to make. To make certain levels of returns, it does require you to not do certain things as it relates to ESG, because doing some of those things do have a financial expense. And so that could impact profit, which then impacts returns. So these things are correlated. You can have them at the same time, but at a certain point, as you want to make more profit, you, by definition, start to impact the amount of social or environmental impact that you want to make. So just understand that relationship between these two things. However, the impact of ESG on financial performance is real, the positive impact. Studies show that companies with strong ESG practices tend to perform better over time. So you might be asking, well, why is that? The reason is because they're already, as part of their practice and policies, reducing risk, right? They're managing their resources efficiently. They're building strong relationships with customers and communities. These companies are not only forward thinking, but they're also better equipped to handle challenges like regulatory changes and market shifts. For example, companies like Unilever, Patagonia, and Microsoft have successfully integrated sustainability into their business models. Some might argue they need to do better, and that's fair. Unilever, for example, has made huge strides in reducing plastic waste and improving labor practices throughout its supply chain. As a result, they've seen an increase in customer loyalty, reduced cost, and better financial performance. And get this, over the years, ESG-focused funds have consistently outperformed traditional funds. This is because these companies prioritize sustainability and are often more resilient during economic downturns or crisis. One of the things that we saw during COVID is that the companies that were ESG focused actually did better and fared better well. They had lower layoffs, and they were able to bounce back far more quicker than some of the other companies that did not have some sort of ESG focus, right? So with that being said, here's your call to action. Take a closer look at your current investments and ask yourself, am I investing in companies that align with my values? If the answer is no, now is the time to start exploring ESG rated stocks. You can really make a positive impact and grow your wealth at the same time. So that's it for this segment. I'm going to ask you to stick around for the final segment where we're going to talk about long-term financial advantages of ESG, investing, and how you can get started today. I can't wait to see you after the break when I show you how to do different better.
You're listening to the special one-year anniversary episode of the Do Different Better show. Stay tuned, as up next we'll play back more of our favorite clips. You're listening to the special one-year anniversary episode of the Do Different Better show. Stay tuned, as up next we'll play back more of our favorite clips. Continuing our celebration of the 1-year anniversary of the Do Different Better show, we'll now play back another one of our favorite clips.
Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. So far, we've explored the basics of negotiation and covered how you can save money on big purchases and everyday services. Now it's time to take things way up a notch. In this segment, we're diving into advanced negotiating tactics and practical ways to hone your skills by incorporating negotiation into your daily life. Trust me, by the end of this segment, you'll be ready to negotiate like a pro, even when it comes to the little things. So let's get started. So first I have to tell you, my master's and doctoral work in grad school was in conflict analysis and resolution. So a lot of what I'm sharing with you, there's actually hard science and lots of years of study that have come up with these negotiation tactics. So I want you to know, these are great whether you're trying to go negotiate a deal, even if you're trying to negotiate hanging out with your friends or where you guys are going to take a trip together, right? So I really want you to pay attention to this because it's just not about negotiating financial matters, but these are going to be some things that you can use in other aspects of your life that are going to be very beneficial. So the first tactic is what's called BATNA, okay? We're going to kick things off with this essential concept in advanced negotiation. BATNA stands for Best Alternative to a Negotiated Agreement. Fancy pants, right? But don't worry. It's really actually pretty simple. Your BATNA is your backup plan. It's the best outcome that you can expect if the negotiation doesn't go your way. So before you even walk into negotiation, you should always know what is your BATNA. That way you have a clear understanding of what your next steps are if the deal falls through or is not seeming like is being operated in good faith or is not coming anywhere near. Maybe you're negotiating with somebody who's kind of one of those negotiating jerks where they're overly aggressive and they're not willing to budge. And here's the best part. It often makes the other side more flexible because they know you have options, right? So here's an example. Let's say you're negotiating a job offer, but you already have a second offer on the table. That second offer is your BATNA. If the employer isn't willing to meet your terms, you're comfortable with saying no thanks because you have a solid alternative waiting in the wings. Once again, here's a tip. Always do your research and have a clear idea of your best alternatives. Whether you're buying in a car or negotiating your salary, knowing your options will help keep you grounded and not emotional in the negotiation process, which will help you make smarter decisions, right? Number 2, building a rapport. The power of building a rapport with the person you're negotiating is essential. Now, there are some people who come from a school of thought of hate your enemy, hate the person you're negotiating with. I don't prescribe to that. I find you get far more with honey than you do with vinegar, right? But you need to know that there are some people that are really grounded in that sort of negotiation tactic. They're just full of piss and vinegar, right? So you just have to know that, and whether it's breathing exercises or whatever it is that you feel that you need, these are the things that you're going to use to negotiate. You're going to use to be able to know when to walk away, right? So here's the thing. People are more likely to give you what they want if they like you. It's psychology 101. And you can do this by starting to establish a connection with the person that you're negotiating. Ask them how their day is going. Find some common ground. Maybe you both have children. Maybe you both have skydived. Maybe you both like hip hop music. Smile. People like to make deals with people they like, right? Now, sometimes you have to make deals with people you don't like, but if given a choice, if you ask people, they much rather do deals with people they like than people they don't like. When you show that you are not there just to win, but to have a productive conversation, the negotiation becomes less adversarial and more collaborative. Once again, understanding that you're going to win some, you're going to lose some. And so the whole idea is, can you win as much as you can and lose as little as you can? So once again, here's another example. Let's say you're negotiating with a contractor for some home renovations. Instead of just jumping right to talking about the price, start asking them about how their business is going, how long they've been in the area, or even compliment them on a previous project that they've done. This human touch can make them more willing to work with you on the final price. Or say to them, hey, if this goes well, I know 3 or 4 people I'd love to refer you to, right? Letting them know that there's a potential for new business and that you're that connection to 2 or 3 more opportunities may be more likely. They're going to give you a little bit of a discount to be able to anticipate getting those other referrals. But I want you to just, once again, don't underestimate the power of genuine connection. A little bit of kindness and respect goes a long way in getting people to your side. When I have contractors come to my house, I'm like, hey, can I get you a bottle of water? Can I get you some juice? We've got some chips here. Can I, are you okay? Especially when they're getting ready to leave the house. I'm like, oh, would you like a water for the road? Right? It just shows that you see them and they're like, oh, this person is a nice person. People want to do nice things for nice people. Okay. Number 3, win-win negotiation. Okay. This is a technique when both parties walk away feeling like they've gained something. In other words, the goal isn't just to beat the other person, but to find a solution that benefits both of you. When you approach a negotiation with the mindset of collaboration rather than competition, it opens the door to creative solutions. Maybe the seller isn't willing to lower the price on that product, but they're willing to throw in a free extended warranty and some bonus accessories. That's still a win for you. And a win for them because they didn't have to lower the price. So here's an example. Imagine you're buying a car and the dealership won't budge from the sticker price. Instead of walking away frustrated, try negotiating for added value. Ask if they can include some free oil changes for a year, or an upgrade on premium mats, or car washes once a month. Even though you didn't get the price lowered, you're still getting more value for the money that you're actually spending. And quite frankly, some of those things don't cost them a lot of money. Here's a tip. When you're negotiating, always be on the lookout for creative win-win solutions. It's not just about getting the lowest price, but about getting the best value. So now that we've covered some advanced techniques, here's the big question. How do you practice negotiation and get better at it? The simple answer is incorporating it into your daily life, as I've mentioned. You don't have to wait for your next big purchase or job offer to practice these skills. There are opportunities all around you to negotiate. So here's 2 tips. Number 1, start small. If you're at a flea market or garage sale, that's a perfect opportunity to practice your negotiation skills. The stakes are low. The people selling items expect a little back and forth on the pricing. Not only is it a good practice, but it also helps you with a few bucks on things you didn't even know that you can negotiate on. 2, everyday services. Another place to practice is in everyday services. Negotiating your gym membership, for example, is a fantastic way to get more comfortable with asking for better terms. If you're renewing a membership, ask for a discount. See if they're offering any promotions. You'll be surprised. Maybe they're offering 3 months of free training. Okay, that's great. If you didn't ask, you would have never even gotten it. And how often you'll get the yes, you'll simply be amazed just because you ask. I am noted in my family. I'm often joked about in my family that people love to give me free things. And I'm like, yes, but I'm also just asking for them. So the joke with my sisters-in-law are always like, yeah, people just love giving stuff away to you, giving you free stuff. And I'm like, well, I don't think that they enjoy giving out free stuff. I just ask for it. So, and I think part of that is because I like to make a game out of it, right? So here's a tip. Make it a game. How many things can you negotiate in a week? Whether it's your cable bill, your phone bill, or even your next online purchase. Challenge yourself to ask for a better deal. You'll be amazed how much you save, and just by being bold enough to ask. But here's another thing. I want you to take the money that you save from all of those deals and put those into a high yield savings account, which then can add up for you to have money to invest into some of the things that we've talked about in some of the other episodes. So now I know that negotiating might feel uncomfortable at first, especially if you're not used to it, but just like any other skill, you just need to practice. Here are some keys to building up some of your confidence. Doing small wins. Every time you negotiate successfully, whether it's getting a $10 discount or negotiating an extra week of vacation at work, you're building your confidence. And guess what? Those small wins add up. Over time, you'll find that you're getting yourself more comfortable. 2, track your progress. I was just talking about this. Another way to build your confidence is to track your progress. Keep a journal or note on your phone that says every time you negotiate how much you've saved. Seeing that number grow will help you motivate you to keep negotiating. And then 3, learn from setbacks. And don't worry if something doesn't go your way. Sometimes you'll hear no, and that's okay. Every negotiation, successful or not, is a learning experience. Ask yourself, what could you have done differently, and apply those to your next negotiation. So here are some practical tips and your action steps for the week. Number 1, identify one low-stakes opportunity to negotiate this week. Maybe it's at the farmer's market, or maybe it's at a garage sale, or just pick something easy and give it a try, right? Action step number 2, practice negotiating on one of your reoccurring bills. Call up your cable company, your insurance provider, your internet provider, and ask for a loyalty discount. Use these tactics that we discussed earlier in the show. Insurance is a big one, and I want to talk about really quickly the cable. So typically you'll have these, they may give you a discount, and they may say, hey, this discount is only good for 12 months, 24 months. What I will do is I will put a tickler on my phone. I will put a meeting reminder. I will put a task reminder of in 11 and a half months to call the cable company back, call the insurance company back, and ask the same question, right? Because they're more likely to keep you at that same price, which is a negotiated price, or you can ask for a lower price than that price on the promotion, right? Another tactic is to wait till the promotion's over, ask for a new discount, and that discount might even be better than the one that you had before. So these are a couple tactics, but once again, it is a little bit of wanting to take advantage on a regular basis. So like I said, for your insurance company, calling them once a year and saying, hey, can I get a discount? Can I get a loyalty discount? Whatever that maybe is. And then finally, the last action step is to write down your small wins. Every time you save money through negotiation, keep track of it and watch how quickly these savings will add up. So here's my final call to action. Don't forget to share your negotiation wins with us on social media using the hashtag #NegotiateBetter. We want to hear about your successes and the lessons that you've learned. And if you're enjoying the show, please leave a review and share with a friend who could use a little help with mastering the art of negotiation. Well, that's it for today's episode of Do Different Better. I hope you're feeling excited to go out there and negotiate your way to better deals and bigger savings. Remember, negotiation is a skill, and the more you practice, the better you'll get. I hope you have found these tips helpful and that you are ready to take action. Thanks for joining me on this journey. Join me in some upcoming episodes when I'll be announcing some very special guests who are offering some great discounted services and events that you do not want to miss. Next week, we're talking about the ins and outs of digital wallets, what they are, how they work, and how they can save you time and stress in the modern financial world. If you have found today's episode helpful, don't forget to subscribe, leave a review, and share this episode. Let me know what you think of the show. We love comments, so tell us how this show has helped you. If there's a finance or money question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. My Instagram handle is Do Better with Elaine. Until next time, stay empowered, stay focused, and I will see you next week when I show you how to do different better.
Thanks so much for listening to the 1-year anniversary of the Do Different Better show. Coming up in future weeks, Elaine will have more new content.